Good afternoon, everyone, and welcome to the Equifax Market Pulse webinar, where we will be talking you through our Q4 2023 consumer credit trends. My name is Becky Oakes. I'm the Vice President of Analytics here at Equifax. And in advance of International Women's Day tomorrow, I'm pleased to say I'm joined by
Good afternoon, everyone. I'm Sandra. Looks like Becky's having a couple of technical difficulties, so I will dive in and go over the platform with everyone. So you'll see on the On24 webinar platform, it's responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try to address them throughout our session today. In the event there's too many questions to get through, we'll reach out to you individually to follow up in the coming weeks. Today's presentation, as well as some related content in English and French, are available for download in the related content area. This session is being recorded, and you'll receive the on-demand link via email tomorrow. We'll also have some polling questions today, so keep an eye out for those. You can provide your answers right within the platform by selecting the appropriate option. Some additional features you'll notice on the bottom of your screen are reactions. Let us know how we're doing. Register now for our upcoming Business Trends webinar on March 19th, our survey, and contact us. Feel free to check any of these out and provide your feedback. We really appreciate it. Now let's get started, and we'll see if Becky is back on track.
Hey, Sandra, hopefully you can all hear me again. I'm so sorry about that. My connection chose the best time ever to disappear on me. So thank you, Sandra. So let's get started talking a little bit about the economic side of things. So we are continuing to see what we are calling a hard, soft landing here in Canada. And what we really mean by that is if we look at some of those economic statistics at an overall standpoint, actually the data doesn't look too bad. And if you look at the GDP numbers for Q4, we were kind of seeing around a 1% growth. The big challenge, of course, and we've been saying this for a few quarters now, is that the population growth we have in Canada, although incredibly positive, is helping to hide some of what's actually happening on the economic side of things. So if you start to look at GDP, for example, per capita, we're seeing that actually continue to drop quarter on quarter. In fact, most of those per capita measures are actually seeing a drop throughout 2023. And what this really means is that for consumers and small businesses, there actually is a likelihood they are experiencing some financial strain right now. And so what we're going to be sharing with you today is really a little bit more around what that means for the credit industry in particular. So just taking a look at some of those high-level economic statistics, if we start with the CPI, inflation, I'm sure you've all seen in the releases from Statistics Canada, year over year, we're seeing that still up around 2.9%. Now, where that's really been growing still is heavily linked to shelter, mortgage interest, housing costs, whereas there has been some relief in some areas such as energy prices and gasoline prices, where we've seen those inflation levels starting to come back down. Now, that does give a little bit of light, I guess, at the end of the tunnel for consumers, because they will be starting to see a little bit more purchasing power for some of those kind of items. The interesting thing as well when we look at inflation is if we actually back out mortgage interest and shelter costs, that 2.9% quickly becomes close to that 2%, if not below. So we are getting closer to that tipping point where potentially the Bank of Canada might be able to look at dropping rates. Of course, they made the decision to hold those yesterday. On the employment side of things, again, it's a bit like what I mentioned at the beginning. If you look at some of those overall numbers, so things like unemployment level, well, that actually fell slightly in January, down 0.1%. Real positive there. It's actually the first decline we've seen since December 2022. And employment rose by 1.1% in December, although that was heavily linked to part-time employment increasing, which is a little bit seasonal as we go into the last quarter of the year. Now, again, the challenge, of course, if we start looking at what this means when we take into account population growth and we look at employment to population ratio, which on that right-hand chart is that dark-coloured grey line, that is actually still coming down. So although, yes, on the surface, employment looks like it's still quite strong, if you look at these measures from a different standpoint, you actually may still see a bit of a decline coming through there with that employment to population ratio. And then finally, just touching a little bit on the housing side of things, we know that house prices were heavily increasing during those COVID months where we had those low rate periods. We did see a drop in housing prices when the first round of those interest rates came in, but then as soon as they started to stabilize, they rose again. That demand came back in again, partly linked to population growth and just more people entering the country looking for somewhere to live. It has now dropped off and stabilized again, but it's going to be interesting to see what happens when we do reach those first round of interest rate cuts and seeing whether or not that demand then leads again to a bit of a jump in overall house prices. On the other side of things, rental prices, they have continued to rise, and that of course puts continual pressure on consumers if those rental prices are increasing, especially in those inner city areas like Toronto and Vancouver, where we've really seen those rental prices continue to rise. So that's a little bit on the economic side of things. If we start to look very high level about what's happening with the consumer from a credit standpoint, I mean, there's kind of 2 or 3 key trends that really are a bit of a continuation from what we saw throughout 2023, although some of these are now picking up pace. We are seeing financial stress increasing across the board, in particular for mortgage holders and in certain geographical areas, which we will dig into. We're also seeing more of the effect now from those high interest rates and those payment shocks, particularly again for mortgage renewals as they're coming up. And we're seeing consumer monthly payments rising and actually seeing some of the implications to credit as those are kind of coming through. So we're going to be talking to you a bit more today around what's happening on that side of things. Just a quick look at consumer debt overall. It's standing at 2.45 trillion, and that's up around 0.4% from Q3. If we actually look at where that's coming from on the mortgage side of things, actually that's really kind of not moved much in the final quarter of final quarter of 2023. The housing prices and the interest rates and everything that's been going on has really meant that the demand for new mortgages has really slumped, with the exception of those renewals and refinancing mortgages that are coming through as they're hitting terms. The balances really didn't change very much from a mortgage standpoint. On the non-mortgage side, Q4 does tend to be seasonally a period where we do typically see rises in non-mortgage debt, things like credit cards as we enter the holiday period. That was actually down a little bit in terms of what we would typically expect from a seasonal standpoint. So we'll give you some more information in a little bit around kind of why that might be happening and where that's coming from. In terms of where the non-mortgage debt has been increasing over the last year, we've been talking about this in the last few quarters as well. Credit cards still is the main product where we've seen growth, and a lot of that is still linked to population growth. We have seen increases, though, just in terms of general usage. So if we look at the percentage of those consumers using their credit card or who has a credit card, that has been increasing for some time, and that continues to rise. And that's also kind of contributing towards that balanced growth on the credit card side of things. We've also seen some growth in terms of installment loans and unsecured lines of credit. And there's a little bit in terms of the auto industry, which has had a difficult period with supply chain issues during the COVID months, and now contending with high interest rates, meaning affordability is quite low. We're actually starting to see some demand for auto loans picking back up again. And some of that is linked to used car prices in particular, which Swanema is going to talk to us about in a little bit, and kind of the changes that we're seeing there. One of the products where we are seeing a bit of a decline is on home equity lines of credit. Now, we did see balances for those fall throughout the COVID months as consumers were paying off more of their debt. That has continued to drop year on year, is down kind of a little bit below $5 billion there. So just taking a look at financial stress. So this is 30 plus delinquency rates that we're showing here. So this is 1 month or more missed payments. Overall delinquent balance rose by a little bit over $3 billion. If we kind of look at kind of where that's coming from and look at kind of some of the key statistics there, You can see cards still leading the way in terms of delinquency rates, although it is remaining a little bit lower than pre-pandemic, which is what the grey bar is on those charts. Auto loans, unsecured lines of credit, they are exceeding pre-pandemic levels, and we've really seen all of those products start to catch up again. So we are describing kind of the delinquent rates here as a little bit of a U-curve caused by what happened during COVID and some of those deferral rates and reduced credit usage dropping those delinquent balances during that period. We are now coming back out of that, and for many of these products, they are back to pre-pandemic levels. Just moving on and looking at, in terms of consumers missing payments, we actually are seeing an increase compared to 12 months ago in volumes of consumers missing payments. It's up around $152,000 people, sorry. And if you look on that right-hand side, you can see what's happening in terms of the split around different consumers and whether they have a mortgage or they don't have a mortgage, and how that is changing in terms of year-on-year movement. So consumers with a mortgage, that is the biggest growth area, I guess, in terms of new people missing a payment on some type of credit product at the moment. It was up 11.6% compared to a year ago, whereas without a mortgage up 9.5%. Now, of course, there's more consumers without a mortgage missing payments, but that growth is kind of an indication of some of that stress that's really entering the mortgage market. And if we compare that to Q3 and the year prior, it is still increasing. So we are seeing this continue to grow. And apologies if you see on some of the slides, we are seeing some comparisons on there to Q4 2022. That should say it should say 2022. Sorry, I'm mixing up my years. So on the consumer side, those with the mortgage are where we are seeing a little bit more movement in terms of missed payments. Some good news on the insolvency side of things. We did see in Q4 a little bit of a drop in terms of insolvency rate, so the percentage of consumers who were becoming insolvent. That did fall a little bit more than we would typically expect to see. Now, if you've seen some of the numbers that came up this week, though, in January, we are seeing that pick back up again. I think it was 20% up in January for consumer insolvency. So a little bit of good news for Q4, but it sounds as though that is picking back up again at the start of this year. When we start to look at where that's coming from, we are seeing consumer proposals. They are still increasing volumes, and we are still seeing those as really the insolvency choice for many consumers that are needing to go insolvent. Those levels are above pre-pandemic. Bankruptcy levels still remaining fairly low, although they are on the increase. And where we are seeing some of those growth levels, I guess, in insolvencies, again, consumers with a mortgage, we're seeing a higher rate of increase when we look at that population compared to others. One of the things we do talk about is what we call surprise insolvencies, and this is where maybe there is no history in the last 12 months of any missed payments for a consumer, yet they suddenly become insolvent. That's still currently sitting at around 31% of mortgage holders who file for insolvency. There is no indication in the prior 12 months that they're going to go insolvent from a delinquency standpoint. So really want to watch around those surprise insolvencies, because it's one of those areas where there may be a sudden change that you're not expecting. One thing we haven't mentioned recently, we just wanted to touch on today, is around credit scores and what's been happening. During the COVID months in 2020 and 2021, we did see the average scores increasing around some of our Equifax scores, and that was really linked to that kind of reduction in credit usage, some of the improvements we saw in delinquency rates. Scores jumped around 10 points on average. We saw that start to tail off in 2022, and we've continued to see that during 2023. In fact, it's picking up pace a little bit. On the right-hand table, you'll see that broken down by average household income, probably unsurprising given a period of high cost of living. When we look at where the biggest score movement is coming from, it's really from those lower income groups. So they have been challenged a little bit more than those individuals with a higher income, although we are starting to see more and more those higher income consumers also seeing some movement in their score. Just moving on to segments of the population. So one of the things we actually did, I think it was about a year ago now, if you were in those webinars that we did, we started to break out where we think there are pockets of risk in the consumer base, and looking at things like changes in their capacity, changes in their payment behavior on things like credit cards. Those individuals maybe that have had a mortgage renewal come through and seen a sudden increase in the payment levels. And so we wanted to just update you today around what's been happening in some of those segments. So on the screen right now, this is consumers that do not have a mortgage, which make up around 72% of the population. Now, what we've actually seen is obviously delinquency has risen for this population. So we're sitting around 3.4% have a current delinquency on their credit file on one trade or more. But what we're seeing is the high risk levels. So these are consumers that maybe aren't delinquent currently, but again, they're showing indications that potentially they might be heading for a missed payment. So things like, high revolving debt, maybe they've got reducing payments, maybe they're reducing their capacity. That's up around 12.4% year on year. So we are seeing that population continue to increase, even though this isn't a group necessarily impacted by things like mortgage renewals. On the medium risk side, again, that's up 3.9%. And then obviously with those two things moving, we are seeing a drop in terms of low risk individuals. So we talk a lot about segmentation and the importance of that. This is, again, just kind of backing that up in terms of it's really important to be looking at some of those groups. And then on the mortgage side, which makes up around 28% of the population or 8.3 million consumers, same trend that we are seeing. We've seen an increase in terms of those that currently have a delinquency on file. That might be the mortgage. That could also be a non-mortgage product that they are missing payments on. And that high risk group is sitting at around 1.5%, and that's up 6.8% year on year. So there are more consumers that are starting to tip into that kind of bucket or that segment where we do believe there is a much higher likelihood of an imminent missed payment coming through. So that's kind of high level what's going on in the economy and what's happening at the consumer level. Kathy, maybe if I can hand over to you, maybe you can share your thoughts on what some of our clients or some of the lenders should be thinking about right now.
Great, thanks, Becky. So as always, I'm going to start off by doing a quick little summary because there is a lot of information provided to us till now. So first off, economic conditions with the high interest rates plus the higher cost of living, well, they continue to put stress on consumers, especially mortgage holders, and for expensive provinces like BC and Ontario. Second thing that we heard was for renewals, which have happened in the last year, well, these consumers have definitely experienced payment changes. And when we look ahead at the renewals in the next 3 years, a significant number of these fixed rate mortgage holders that are locked into low interest rates, they're definitely going to see some payment shocks. So in terms of, what we're seeing as current and emerging trends, credit activity is really slowing down, which means consumers are being mindful of their spending habits. However, there's still a risk in their ability to make payments on already existing debt. So this applies to both mortgage holders and non-mortgage holders. We also heard that, 30-day plus missed payments are up quite a bit, which is an early warning sign for financial stress. And when we double click on this, we saw just as Becky explained through the segmentation analysis, it really does help carve out the profile of consumers that are more at risk. When we look across the globe, we see similar trends happening in terms of stress elsewhere. Our friends down to the south of us, they're reporting a spike in credit card delinquencies, while across the pond in the UK, consumers there are relying on their credit cards to get by, and they're actually maxing them out. If we go now a little bit further to Australia, we see some interesting news there. Australia has a national hardship law that mandates creditors to assist consumers with hardship assistance if they come forward. And so what's interesting there is that consumers that do take this path and are placed on some sort of a repayment arrangement, they actually recover much better from financial stress than those that don't. So lots of trends happening there, but the big question is, as a lender, what should you be thinking about? So we've already talked a little bit about financial stress, but for a lender in 23, that really meant adopting the new Basel III reforms, which saw an increase in the capital requirements. And so as financial strain and losses rise, we expect provisions to be adjusted. Nice little segue to, reminding lenders, about your collection strategies, continue to optimize them, look at your approaches, and mirror the hardship assistance program in Australia for better recovery and overall like a positive curing experience for consumer in that position. Next thing I just want to touch on is like the biggest task for a lender is going to continue to be understanding the portfolio of customers and leveraging current refreshed credit data to get that full financial picture on all open trades, right? What are the balances? What are the repayment amounts? Coupled with this segmentation approach to really allow you to isolate the vulnerable pockets of consumers who are experiencing more stress. Once you know the pockets of where you have risk, you can also focus on the pockets where there's growth opportunities as well. Okay, so on that note, we're actually going to move to engaging our audience to a poll, a two-part poll question. Sandra, if I can ask you to please push through the first question. All right. Yes, interest rates were held yesterday, but big question, and I don't know who's got a crystal ball out there, but when do we expect that the Bank of Canada will start to cut rates? Do you think it's at the next one, April 10th, June 5th, July 4th, or do we have to wait until September 4th? Lock in your votes right now, and we'll see how everybody feels. All right, I see folks are submitting their thoughts. I'm gonna give it another 10 seconds. Hurry, hurry. All right, Sandra, can we see the results? Okay, so definitely not next time around in April, but it looks to see that we've got sort of a split feeling in terms of June 5th, July, and September 4th. So great, I love the optimism. So the next part of our sort of the poll question is actually, all right, we're gonna start to, a cut, but what do we think the velocity is gonna be thereafter? So Sandra, if you can push forward the second question. Do you think it's going to be a steady stream of modest cuts? It's going to be cut and then hold and monitor, or one deep cut and done? So what do you think the Bank of Canada will do? Lock in your votes. How will the Bank of Canada proceed once they start cutting rates? All right, we're gonna close the polls. Let's see what everyone thinks. Wow, it looks like the majority think cut, hold, and monitor, which sounds like a very conservative approach to cut once and let's see what happens. So thank you for your engagement. I'm now going to pass it back to Swarnima, who's going to give us a deep dive on what's been happening in the credit card space.
Thanks, Kathy. As usual, we'll start off with credit cards. As mentioned by Becky, credit cards have been the biggest driver for credit growth in the last 1 year. Outstanding credit card balance is now at a record high of $116 billion. To better understand the credit card debt distribution, we can divide it as balance originating from transactors, so people paying their credit card balance in full, balance accumulated by revolvers, people who are paying less than 90% of their credit card balance, and balance generated by new to credit consumers, and delinquent balance that is rising from missed payments. The inner circle in this chart is the balance distribution for 2022. And the outer circle represents the balance distribution for 2023. And we are seeing a shift in consumer payment behavior. Year-over-year growth in a revolving balance continues to outpace the balance growth that we normally get from transactors. So for this quarter, transactor balance rose by 12%, while revolving balances rose by 17%. But the maximum increase in balance that we are seeing for Q4 2023 is coming from missed payments. Delinquent balances went up by 33% from 2022, and now form 5% of total credit card debt. The proportion of balance that was being driven by new to credit consumers has also slowed down this year, which is correlated to the new card origins. Now, new card originations declined from the last quarter, but overall, 2023 has seen a very strong growth for credit cards, with over 6 million credit cards issued just in 2023. And this is the highest credit card growth we have seen in a year. The proportion of new to credit consumers has declined slightly, as I mentioned before, and this quarter as the immigration slowed down a little towards the end of 2023. But still, new to credit consumers form close to 30% of new card originations. Another change that we have been seeing for past few years is at the increase in average credit limit assigned on new cards. It's now at an all-time high. The chart on the right shows the credit limit on new card originations across different score groups and their year-over-year change. So average credit limit is now close to $5,000, up 17% from Q4 2022. And for high-risk segments, the average limit assignments is, yes, lower than the overall average, but the rise in credit limit has been very similar across all risk segments. Another driver for credit card growth is the consumer spending. Now, we have shared these charts before, and I'll explain again what these mean. The chart on the left shows the average consumer spending per credit card holder. The chart on the right shows average monthly credit card spending per consumers after removing inflation. So we do see that consumer spending is coming down. For the chart on the left side, without the inflation, we see that the 2023 spending is slightly higher than 2022. But once we adjust it for inflation, we see that the spending actually is lower than 2022. So consumers have pulled back on spending. And this is what we see once we remove the inflation and see the adjusted spend. And the spending is, yes, lower than 2022, but the green line that you see, which is the 2023 spending, is still quite higher than 2019. And the spending in this year has been reduced by multiple factors. Retail sales have been flat compared to past year. High housing costs, minimum payment requirements on credit products are up. So consumers are prioritizing payments over spending. But despite adjusting for inflation, the credit card spending is still higher than 2019. And in the next slide, we will see consumer segments that have seen maximum shift in credit card spend. So we created 4 spend buckets after adjusting for inflation and looked at the distribution of consumers across each spend bucket and their year-over-year change from different age groups. So overall, 30% of consumers are now spending more than $2,000 on their monthly on their credit cards, which is up by 6% when compared to 2019. And we're seeing the maximum movement between spend buckets for consumers in the age range 35 to 55, who are the most credit active consumers and have high spend levels. But if you look at consumers under the age 35, we are seeing a similar shift, with 22% spending over $2,000 monthly on their credit cards when compared to pre-pandemic. So clearly, consumer consumption and reliance on credit card is now higher than what it used to be back in 2019, but the spending is lower than 2022. And the slowdown in spending from 2022 is there, but balances are still rising. That means consumers are paying less and less of their outstanding balance. And as discussed before, revolving and delinquent balances are increasing at a much faster rate. When we split the consumers by mortgage holders and consumers with no mortgage, we see the biggest increase in average balance is actually coming from mortgage holders. In general, mortgage holders have high credit card balance than non-mortgage holders. And as of Q4 2023, the average credit card balance per mortgage holder is over $6,000 and up 15% when compared to the same time period last year. So while the non-mortgage consumers have an increase of 9% on their credit card balance. As balances have gone up, we have seen that the payment rates have declined. So payment rate is the percentage of credit card balance paid by the consumer. The chart on the right shows pay rates for mortgage and non-mortgage consumers on their credit card. Historically, we have seen that mortgage holders have a much higher pay rates on their credit cards than consumers with no mortgage. And the gap in pay rates was much higher back in 2021 when the interest rates were very low. But as we head into 2024, we see that the average mortgage holder is struggling with credit card payments, and their pay rates is now same as non-mortgage consumers. Now, lower pay rates have led to higher delinquencies. We have again split the consumer base into mortgage versus non-mortgage consumers to see the impact of credit card payments. For mortgage holders, especially in Ontario and BC, the credit card delinquencies are fast approaching pre-pandemic level, while in other provinces, you see that they're still below 2019. Clearly, interest rate pressure on mortgage holders is impacting payment behavior in these provinces. We'll talk more about the financial stress from Ontario and British Columbia in our mortgage section. Now, moving on to non-mortgage consumers. If you look at the credit card delinquencies, everything is closer to pre-pandemic. And in Ontario, it's higher than pre-pandemic. In British Columbia, is very close to reaching 2019 levels. Financial stress is, again, more visible in these provinces for all consumers. And as Kathy mentioned, high cost of living, huge home loans, and are impacting both mortgage and non-mortgage consumers, and it's reflected in their credit card delinquencies. Now, the impact of interest rate is not just visible on credit cards. We're also seeing a much bigger impact on unsecured and secure line of credit, which are heavily attached to interest rates. The chart on the left shows delinquencies for unsecured line of credit across different age groups. As you can see, the balance delinquencies are above 2019 for all age groups. It has impacted consumers who are under 35 years of age, and they are missing payments at a higher rate than other consumers. Now, average balance per line holder for this consumer segment is also increasing. They are drawing on their lines to meet expenses and hence missing out on payments. While unsecured lending impacts younger consumers, a home equity line of credit impact is more visible on older consumers. So older seniors and consumers between the age of 26 to 35. While the volume of HELOCs for these two consumer segments is small, their delinquencies are rising at a much higher rate. For seniors, we have seen this behavior before. We have seen a similar rise in missed payments back in 2018 when the interest rates were higher, and that led to more insolvencies from seniors. But younger consumers were not impacted back in 2018 as they are now. Mortgage growth that we saw in 2021 also fueled demand for home equity line of credit. So consumers in this age group, many first-time home buyers, took advantage of low interest rates, got mortgages, HELOCs, and are now struggling to make minimum payments. The minimum payment requirement for this age group for HELOCs is now at $420, which is over $200 when compared to 2021. So interest rates have impacted credit card payments as well as HELOC payments for all consumer segments. Now I'll hand it over to Kathy to explain what that means for the lenders.
Great. Thanks, Ranima. So again, this might look a little bit different, but before actually I dive into the slide, let me just do what I do always, which is unpack sort of a quick little summary on what we just heard. So first off, credit card debt, all-time high, a lot of it being fueled by the newly issued cards with higher limits. And when we double clicked on this, as we heard from Swarnima, we saw that the average card spend per consumer has actually come down when compared to the previous year. But I'm going to throw out a big but here. It's the payment rates that have also declined, especially for the mortgage holders. So in really, really sort of simple terms, even though we're seeing new spend on cards slow down, the balances are actually growing. And that's because it's the ability to pay down is decreasing. Last thing that I just want to touch on and we heard is the 90-day plus delinquency slide for the cards, right? We're seeing that it's approaching pre-pandemic levels, but for the unsecured lines, it's already there. We're already at pre-pandemic levels. So we're going to dive into this slide, which is kind of related to sort of the poll question with regards to, let's think about a world where the Bank of Canada starts to drop some interest rates. And what do that mean for revolving credit holders? So let's assume it drops first off, we can expect that, consumers will have lower monthly obligations, which will mean some excess cash flow to either spend a bit more or maybe pay off some debt. But if interest rates do drop too fast, we've undone the problem, right? And we're back to having that high inflation come back in and the higher cost of living. But on the plus side, if minimum payment requirements drop for like line of credits, this can slow down the delinquency rate because we've got less payment that's required to stay current. Now, let's talk about the side which is maintaining these high interest rates. What does that mean, right? Lenders are going to see reduced revenue margins and more losses are going to come from consumers with low cash flow or financial stress. Lenders are also going to see some higher interest rate revenue from like the outstanding balance because there's interest being charged on top of that, because there's going to be also reduced payments on the card balances. So coming back to the question that I like to pose all the time, what should lenders be thinking about? So first off, when you're looking at revolving total balances, it's important to understand how it's changing. What are the drivers? Remember, segmentation is your friend. It's a key tool that'll help you look at the homogeneous groups to understand their credit profile, like understand the credit situation. You need to use refreshed credit data to help you understand what may be happening outside of your relationship with that customer. Ask yourself, are certain segments spending less? Are certain segments, using HELOCs to support themselves through financial stress with some of your competitor cards? Really get to the root of why is the balance changing, okay? Lots to think about there. But on that note, we're going to shift gears right now. We're going to sort of drive into the auto industry. So back over to you, Swarnima.
Thanks, Kathy. So let's talk about auto. Similar to last quarter, auto demand has remained high. Portfolio balances are up year over year for most auto segments, except for leases. So for leases, year over year growth is lower, but from last quarter is actually quite high. So leases have been increasing. The demand for leases has been increasing. That's why we are seeing quarter over quarter growth in auto lease. It is not yet translated to year over year. Growth has been driven by high new originations in auto, as well as we're seeing an increase in delinquent balances. So we'll start with new originations. Auto leases have rebounded this quarter after staying very low in the last 2 years. High auto lease demand is being driven by super prime consumers, so consumers with very high credit score. Average loan amount for auto leasing has also gone down from last quarter and is now around 31,000. New vehicle availability and a slowdown in rising car prices is fueling auto lease growth. While new auto loan originations are also up from last year, we are seeing high demand for both auto loan and leases, especially coming from seniors, where we saw close to 40% growth in new originations when compared to last year. But the demand is still slightly lower than what we had seen back in 2019. For new cars, the loan originations has again rebounded. We have seen that the new car loan originations dropped considerably back in 2022, but now we are seeing an increase in new car segments. The year-over-year growth is higher. New vehicle prices have gone down. The prices of new vehicles have gone down for the first time in this quarter. We are seeing a quarter-over-quarter drop in average loan amount for new cars. And we could see more demand for new cars this year as prices stabilize. High loan amount, in addition to the current interest rate, is still a constraint for many consumers. The chart on the right shows the distribution of new car loans against interest rate bands. And as you can see, the distribution is getting skewed towards high interest rate loans. A lot of the zero interest loan offers that we saw back in pre-pandemic no longer exist. Monthly payments on cars have gone up over $200 when compared to new cars that originated back in 2019. Now, average interest rates on new cars have seen major shift in the past 2 years and is making affordability a little challenging for many consumers, but drop in car prices as well as interest rate could drive demand in 2024. However, used car segments is now seeing a drop in new originations. Used car prices are no longer rising. They're maintained since 2022. We have not seen an increase in used car prices. And as you can see on the chart on the left, the orange line shows the average loan amount on used cars went up from 25,000 to 35,000 from 2019 to 2023, a very significant rise in used car prices. And higher loan amounts also led to an extension of amortization term on used cars. So close to 45% of used car originations now have a 7-year or longer term. And this was around 28% pre-pandemic. Now, auto balance delinquencies, as mentioned before, balances are being driven by both new originations as well as missed payments. Auto balance delinquencies are now either higher than pre-pandemic levels or nearing 2019 for most regions. The highest increase so far has been in British Columbia. Now, consumers in the age range 25 to 45 are also seeing a much higher increase in delinquencies because their monthly payments are higher. Overall, and the delinquencies are rising for bank loans as well. So overall, bank loan delinquencies are below pre-pandemic, but when you look at used car segment, that's where we are seeing the maximum increase in auto delinquencies. In fact, the used car delinquency for both balance and account level is now over 2019 levels. We are looking at both balance and account level delinquencies to make sure we understand the huge growth in balance is not impacting the overall delinquency rates. And a lot of the delinquencies that we see for used cars is actually coming for newer loans. So used car loans originating from 2021 and 2022 are missing payments at a much higher rate as early as 6 months after being booked. And if you look at this chart, if you look at our loans originating back in 2018, they did not have the same level of delinquency after being open for 6 or 12 months. So clearly, the shift in the used car market over the last few years is really impacting consumers and could lead to further rise in delinquencies. I'll hand it to Kathy to go over the impact of changes in interest rate for auto industry.
All right, thanks, Swarnima. So once again, my summary of what we just heard. So just really quickly, for starters, the auto market, right, it continues to rebound with some really strong growth coming from the new loans and leases. While we heard on the used car side, we've seen a slowdown, which is related to, prices are correcting themselves as the supply improves. And on the delinquency side, we're definitely seeing levels rise for both used and new cars. And when we looked at more closely at the subprime loans, we actually see this trending upwards. And a lot of it's being driven by the younger consumers that have no mortgages. So big question again, what will happen in the auto industry if interest rates start to fall? So first off, financing is going to become cheaper, and this is going to drive more consumers to being able to afford a car, which in turn impacts, pricing being stabilized. Overall, lenders are this is good news for the lenders because there's going to be less risk on defaulting and more value left in the car. But for those that already have loans, they may look for an early payout, right? Drop the higher interest loan, go pick up a lower one. And this is especially going to be true for less risky customers who are going to have the ability to do that, right? Versus the riskier ones who, may not be able to secure a lower interest rate elsewhere. So as a lender, your book might end up being skewed with higher risk consumers being left. On the flip side now, again, let's pretend that our interest rates are going to continue, which they are right now. So this is going to heavily impact the subprime market, who may not be able to qualify for a loan. And when you have less demand in the market with the same amount of supply, let's go back to our good old economics learnings, price is actually going to drop, which means less residual value in the vehicles. And we can expect then delinquencies to start to climb because the combo of longer terms plus higher rates, it's going to continue to burden the financial health of consumers. So given that state, again, what should you be thinking about or doing as a lender? So first off, provisions. Mentioned them before, I'm going to mention them here again, for capital requirements. You might need to adjust them, again, depending on what happens with the interest rate. If the interest rate does stay high, right, you're going to expect more delinquency that evolves into financial losses. Next thing, as a lender, you should be looking at the different types of scenarios, right? Of where you're going to have adjustments ready for your adjudication and your account management strategies. Like think of it like a playbook, right? It'll allow you to quickly react and minimize the impact to your risk levels. Last thing, if you joined us for our fraud webinar last week, you probably heard us talk about identity fraud really impacting the auto industry and contributing to financial losses. This is another place where as a lender, you need to understand where you have more risk and losses coming through and make changes, right, to your strategies to minimize these occurrences, okay? So I think on that note, I am gonna pass it back to Swarnima to take us home with mortgages.
Thanks, Kathy. We continue to see a slowdown in the mortgage market with slowest year-over-year growth since interest rates started to rise. The chart shows year-over-year growth in mortgage balance in the last 3 years across all provinces. It is important to note how huge was the growth, especially in Ontario and BC, during the lowest interest rate period, and how big is the slowdown now in these provinces to understand how it affects certain trends for these regions. The biggest factor in mortgage deceleration has been new originations. In 2023 has seen the lowest mortgage new originations in the last 10 years. While mortgage demand has been low across most of Canada, prairie provinces have actually seen a double-digit growth this quarter. And new mortgage volumes in Alberta went up by 21% when compared to Q4 2022. And a lot of it is being driven by high housing demand in Alberta, which is again further driven by the high inter-provincial migration, which Alberta is seeing, especially from provinces like Ontario and BC. And average loan amounts, however, has not seen the same drop since 2021. Similar to the house price trends that Becky talked about on slide 5, average loan amounts are dropping following interest rate hikes. And then it went up when the rates got stabilized a little and has now dropped again this quarter. And average loan amount in Canada is now around over $300,000, down by 5.6% from last year. But compared to 2020, compared to pre-pandemic, the loan amounts for houses are still quite high. We are also seeing a drop in proportion of first-time home buyers in new mortgage originations. Continued high home prices plus high interest rate is making home purchasing challenging for many first-time home buyers. The chart on the right shows the change from last year in the average loan amount and monthly payments for first-time home buyers. And we see that despite the drop in average loan amount in 2023, the payments amount for first-time home buyers continue to go up. So on average, a first-time home buyer is now paying around $2,500 in monthly payments for a loan amount of $400,000, while buyers back in 2021 were paying around $1,700 for a loan amount of $420,000. So cost of borrowing is pushing many first-time home buyers out of the mortgage market. Impact of interest rate is also visible on mortgage renewal. Estimated 35% of mortgage renewal in Q4 2023 saw a monthly payment increase of over $500 upon renewal. This was around 30% towards the end of 2022. In 2021, payment increases were minimal as most mortgages where payment went up was mostly due to refinancing for a higher loan amount. But for 2022-2021 renewals, the payment rise was very less for most mortgage holders. However, the payment shock has not been same across all provinces. Like we have touched upon earlier as well, Ontario and BC mortgage average payment went up by over $600 upon renewal, while in other provinces it was close to $400 or under. This is a big change for renewals and refinances, what we saw back in 2020. And if interest rate remains steady, we will see more payment shocks come through from the upcoming renewals, especially for Ontario and BC, where mortgage holders have huge loan amounts. Now, getting a closer look at the delinquency levels from these two provinces. So high monthly payments are leading to higher missed payments. The delinquency levels for Ontario, the balance delinquency levels for Ontario and British Columbia are already higher than 2019 levels, but the account level delinquencies have remained lower. And we see a much bigger movement in balance level delinquency, partly because of the slowdown in the mortgage growth that we're seeing now after that huge increase in 2021. So delinquencies are mostly catching up to where they were back in 2019. But there are certain consumer segments where we are seeing both balance and account level delinquencies higher than 2019, which is the mortgage holders in Ontario, where the younger mortgage holders in Ontario under the age of 35. That's where we're seeing the maximum rise in delinquencies in Ontario. But when we look at other provinces, we don't see the same increase in mortgage delinquencies. As you can see in the chart, the delinquency levels are still lower than what it was back in 2019, because these mortgage markets have been much stable than Ontario and BC. The growth and the slowdown has not been that high, and hence we are not seeing the similar increase in mortgage delinquencies in the rest of Canada. Now, drilling a little deeper as to where these delinquencies are coming from, we see that the mortgages that are opened in 2022 and 2023, similar to used car loans, are missing payments at a much faster rate than mortgages that were opened in 2017 and 2018. This is the vintage chart that shows the performance of mortgages opened from Jan 2017 to Jan 2023, and how they performed 6 months, 12 months, and 24 months after being on booked. And as you can see in the chart, the level of delinquencies for newer vintages is much higher than what it was back in for 2017 or 2018 mortgages. Now, credit performance for mortgage holders is deteriorating, especially for upcoming renewals, especially for recent renewals. So as discussed before, recent renewals are getting a payment shock. And some of them are not missing payments on mortgage, but missing payments on other products. So if we compare the credit performance of mortgage holders and look at mortgage holders who recently renewed and had a payment increase of more than $500, we are seeing that they're starting to miss payment on other credit products at a much higher rate than other mortgage products. And now I'll let Kathy expand more on that. Over to you, Kathy.
Great, thanks, Ranima. And I know we're running out of time, so I will be quick. Actually, I touched on this slide. Just quick little summary again. You know, we've got a cooling housing market, right? We've hit the 10-year low for new mortgages opened. This all relates back to the fact that we've got less people selling and really less people buying, given that the interest rates are so high. On top of this, you know, first-time home buyers, right, you know, really can't get into the market because affordability is so hard. And for renewals, we're seeing payment shocks really across the board, especially in BC and Ontario, which explains why they also have, you know, higher delinquency rates. So shifting gears now and looking at this slide, right? This is more of an illustration that looks at, you know, let's look at the mortgages that are renewing in the next 3 years, right? And the potential impact on the consumers, given the fact that, you know, interest rates are expected to drop. So, you know, for those renewing in 24, on average, they're coming off of an interest rate that's about 3.78 versus those that are, you know, renewing in 25, around 2.55, and for those renewing in 26, roughly around 2.76. And now just imagine, right, that the posted 5-year fixed rate is about just under 6% and the variable rate is about 7%. You know, across the board, you know, all these consumers are gonna experience a payment shock, but it's gonna be different degrees, right? If we do start to see the Bank of Canada's interest rate drop this year, hopefully, you know, it's going to have to be at least 1% by the time the 25 cohort is up for renewal to really help soften the degree of the payment shock and be comparable to the 24, because again, the interest rate is actually lower for that cohort group. So this is a nice little segue to talk a little bit about, you know, what do we expect to happen if the rates drop and if they stay high? So if they do drop, you know, yes, payment shocks, we're going to ease. But you're also going to see some pent-up demand, right? Start to heat up the market. You're going to have a lot of buyers come out looking for new homes. And again, if that happens, guess what? You know, we might have an inflation problem again. On the plus side, you know, less strain on the mortgage holders, which means they're going to have better financial stability and less chance of really defaulting on their other credit products. Now, if interest rates do remain high, the pressure that we're seeing today, and especially in BC and Ontario, going to get worse, right? And we're going to see delinquencies rise across all provinces, and then it's going to trickle down into non-mortgage products as well. So overall, we're going to have more consumers really experiencing financial stress. And lastly, some consumers may look to insolvencies as a way out of debt, right? Protect the asset, get rid of the debt. So big question again, as a lender, in this space, what should you be thinking about or what should you be doing? So again, if you've got consumers that have upcoming mortgage renewals, you got to look at their cash flow capacity, right? And what's the impact on their non-mortgage debt? This is where, again, monitoring your customer's financial position very closely is going to be important to see, are there any early warning signs with regards to, is there risk there? Also, the number of delinquencies are expected to climb, but be aware that looking at just delinquency rates might be misleading. You should look at the number of delinquencies because remember, the rate incorporates also the balance increasing, which is going to be fueled by those newcomers coming into Canada. Last thing, again, for consumers renewing, they may feel a little vulnerable and they may look to commit first-party fraud, which is a nice way of saying, fudging some numbers if it means, getting a better interest rate. Again, as a lender, it means, having processes in place where you can validate the information that's being provided to ensure this type of fraud is being limited. Okay, that's it for me. I know we've got a whole 3 minutes left. Becky, over to you. I don't know if we've got some time for some questions.
Thank you so much, Kathy. Yeah, we have had so many questions come in, so I promise we will go through all of these afterwards and send out some responses to them. Just to kind of touch on a couple, though, there's been a couple of people were asking about stress testing at higher rates, and is that going to help, or why isn't it helping more with delinquency levels? I think the short answer is it probably is helping with delinquency levels. If we go back to look at the last period of interest rate rises, 2018, 2019, they rose at a faster rate quicker, I guess. It definitely has given some buffer, but at the same time, you've had significant increases in cost of living. So although some of those numbers and some of the things, if you think you're going back 5 years when some of these mortgages coming up for renewal were initiated, cost of living is much higher. They've got opportunity to also add additional debt, during that time period. So that's probably impacting some of those numbers and kind of starting to impact more on the delinquencies as well. I think there was a question around credit card delinquency rate in 2019 versus 2023. I think we showed the numbers for the 30 plus, which was I think 5 to 5.24. If we're looking at the 90 plus, I think it's around 3%. So I'm going to keep me honest here. Yeah. But we can certainly kind of give some details on that one. And then the only other question I'm going to have plenty of time to touch on right now was actually a question around wondering if these trends in general that we're seeing at an individual level are the same for business side of things. Obviously, small business is incredibly important because it employs a lot of people. A lot of people are self-employed. And the good news is that I can share that on the 19th of March at 1 o'clock, Sinead is going to be doing our Q4 business credit trends update. So if you're interested in what's happening on the commercial side, highly recommend tuning in for that one because she definitely will be covering a lot, and there's a lot going on with insolvencies and things on small business. For everyone else, thank you so much again for joining. I'm sorry that we ran out of time. We will do our best next time to try and condense it down so we have more time for questions. But thank you so much for joining us, and we will see you next time.